First of all, apologies for the TTS, my goal is to focus on research and mathematics, and recording with my dollar store mic has been a nightmare and time consuming. Alright, here we go. "No one knows where the price will go in the short term," is probably one of the most common phrases you'll hear in the finance community. People love to take it and run with it, and make sure to repeat it to every new person they meet to let them know that they are indeed a very intelligent investor.
Nobody knows if the stock is going to go up, down, sideways, or in fucking circles.
After hearing this over and over again, it got me thinking, do market patterns even exist? So for all of our sakes, I will try to answer that question here today. Before we begin, let me clarify what types of patterns I'm referring to. It's no secret that we can consistently observe high implied volatility before key dates, and we see sharp declines post-dividends. Are these patterns? Of course. But today we will consider the patterns that you are all interested in, the regular intraday movements. We'll be taking a unique approach to this problem. Rather than testing a single specific strategy, we will use reinforcement learning to train a model on a large set of data. Then we'll test its abilities on both the trained data set, and most importantly, out of sample data. If the model is able to perform well on unseen data, it'll be strong evidence, if not immediate proof, that market movements are not random. And yes, in a sense we will have built the ultimate day trading tool to predict the short-term price movements of an asset. Let's get a big picture overview of this process. We'll be using OpenAI's GIM package in Python to interact with our models. They've provided a framework that facilitates the information flow between our environment and our algorithm, like the current state of the environment and the suggested action. On top of this, we will be using the Stable Baselines package to train and evaluate our models. They have designed a variety of high-quality algorithms to execute the task defined in our environment. That leaves us with the environment itself. While GIM has nearly 1,000 presets, they do not have one for trading stocks. Luckily, someone has already faced this challenge and shared their solution. We will be importing the GIM Any trading environment, but making multiple changes to the reward function and the input parameters along the way. Okay, step 1 is getting data. I'm less interested in trying to find patterns on big time frames, so it took some digging to find an affordable, quality data provider for lower increments. Luckily, Barchart has a service that provides minute data going back to 2008 for the S&P 500. I've also cross-checked the numbers against the data provided by the Think or Swim on Demand tool. Now it's time to set up the model. I've borrowed the starting code from Nicholas Renault, so be sure to check out his videos if you are interested in building your own models. After a lot of debugging, I was able to set up a virtual environment and install all the right versions. After importing the data into the script, I decided I wanted to pass the following indicators: RSI, MACD, the distance between the SMA and the price, and the time of day. All normalized to a range between -1 and 1 based on the boundaries present in the training set. In order to pass more than a single column of data, I had to make some changes to the original environment. Before we begin training our model, we need to set aside some data to evaluate it on. I'm going to make a 70-30 split in order to catch a substantial amount of dates before and after COVID in our evaluation. The train set begins in May of 2008 and ends in December of 2017, with the rest going towards our evaluation set. First, I tried a function that rewarded or punished the algorithm on every single piece of data, depending on whether the algorithm was long or short. I trained the model for a total of 4 million time steps, saving a version every 100,000 steps. We can now import our model of choice and evaluate its performance by looping through the data and simulating the buy, sell process. Our first run is tested on the training dataset. The environment has built-in functions to track the total reward and total profit, which get printed in the info dictionary. At the end of our run, our algorithm accumulated a total reward of 2.768 and a total profit of 13.38. Notice the values are different because profit grows exponentially while reward is linear. So our model was able to optimize its performance for the trained data set. Now let's take a look at the evaluation set. Unfortunately here, the model wasn't able to perform well, returning a 40% loss, mainly during the sudden COVID crash. Next I tried rewarding or punishing the total return of each trade. I also felt like I had a large enough set of data and wanted to try a bigger evaluation size. I decided to make a less standard 50-50 split, which made my training dataset end in March of 2015. Again, let's first run our model on our trained set. I'll also keep track of the cumulative profit as the model is being evaluated so we can graph the returns. Once again the model has performed quite well, returning around 25x. Now, it's difficult for me to truly express my excitement given that I've known about this for some time now, but let's take a look at the evaluation dataset. A staggering 4x return. Most importantly, we can even see the way market patterns have changed post-COVID. I was able to further improve the model by playing around with my reward formula and accounting for events that aren't representative of the general market conditions, which gave me an even better curve. Regardless, I believe that even our first model has already answered our question. Market patterns do exist. But does this mean we've just created a money printer? Well, no. If we keep track of the number of trades that happened throughout this time period, we'll count over 120,000 of them. Factor in the cost of spread and slippage and you may as well invert your profit curve. Finally, the environment has a built-in render feature that will display our trades on top of the price movements of the asset. You can use this to visualize when the algorithm chooses to go long and when it chooses to go short. In fact, for the past 7 minutes you've been watching our model in action. So, that's it for this one. Hopefully it inspires some of you to take a look at the possibilities of data science and math in financial markets. But for now do me a favor and share this video with whoever needs to see it, and let me know if you'd want to see more interesting research in the future. See ya.